Good morning, everyone. Great to see you all here today, bright and early this morning, and after a fantastic opening session. We've got some key investors with us on the panel today, really ideal to give us a snapshot of what the industry is seeing at this point and what we can look forward to in 2016. So let's get started. And Shekhar, let me kickstart with you. We've seen a lot of churn, a lot of volatility in the markets, particularly in the last few months of 2015. So what's in store for this year when it comes to investment trends, deal trends? What do you see happening, especially at the early stage?
Yeah, good morning. Hello. Yeah. So, if you look back, and those of you who were in the industry in 2014, 13, 12, maybe 14, is what you will see in 2016. I think 2015, we need to rub it off, erase it from our memory, whatever happened. It is not the normal. The normal is what we used to have in 14, where good businesses are built, entrepreneurs are going after interesting ideas, unit economics are real, VCs take time to put money in, they write normal checks, and then they go to Series B, Series Cs, and build real valued companies. That is back in 2016.
Okay, so Vani, what does that mean? And have investors become a little bit more selective? Are early stage entrepreneurs going to find it a little bit more difficult to get funding at this stage? Because we saw a surge of deals that came in, in the last year or so. What's the silver lining? Because from an entrepreneur's point of view, the first reaction is, oh my God, this is going to get tough.
I don't know if it is going to get tough if you really have something that is a unique value proposition and you are passionate and committed to build a business for the long term. At Kalaari, we invest, and I'm sure this is true for both of my colleagues here, we invest 10 to 12 deals a year, and each of them might have a certain number that they invest, but that hasn't dramatically changed for us year on year. What had probably changed is the compression of time in which people were expected to make a choice, and I think, the proper diligence so that we are deeply committed to the enterprise for the long run, versus saying, oh, maybe I'll miss a deal, I don't really know what this is about, but let me put my money, which is not good for you also, because you're not getting a partner working with you who is as passionate and vested in believing what you believe. So for us, I don't think 2015 or 2016 were any different, except for in 2016, maybe there is more time to have sensible conversations, and the relationship is set up for better longer-term success. Because while we saw 14, 15, some crazy behavior, it worked both ways. If the company didn't take off like a rocket ship, you probably didn't have a company. You didn't have time to be able to recover, make mistakes, which is what startups are all about. There were no second chances. But now I think you can actually discover what is the product, what's the price point, what is the customer value proposition, which is part of the journey and needs to be.
I think let me bring you in here. You look at a lot of early stage investments. Yeah. Do you see a shift in the types of companies you'll be looking at, the number of deals that you'll be doing?
You see, the challenge, as Vani already pointed out, is that you don't dramatically shift the number of investments you can make, right? It's very difficult to build our teams, and the venture model itself is not rapidly scalable in some sense. And that's been a challenge globally. It's not an India problem. So what then has to happen is new players have to emerge. So the topic title is actually very apt, the Big Bang. Right? Yeah. So I think, unfortunately, it's not like one moment in Indian venture history. It's taken 10 years to get here. But I think last year was again a seminal, like one of those iterative moments where everybody got a glimpse of everything that can be. But have we arrived? I don't think so, right? Okay. So we are for the first time seeing tons of teams come out of Flipkart, Ola, Snapdeal, Freshdesk, etc., or Zoho. Yeah. This, if you looked at 5 years ago, it was out of Yahoo Labs, Google Labs, Infosys, Wipro. So what has happened is your ability to see multitudes of great founders and startups has suddenly increased. But it's not like there are 100 new investors. There are a lot of angel investors. Right. So to your point, yes, there's a lot more widening of the funnel on the top. There's a lot more deal flow coming. But I think the caution for most young founders here is that the copycat ideas don't work. Everybody tends to see what is a consumer problem. If you take a drive from here to central Bangalore, there are 20 consumer problems to solve.
Right.
But they're all execution-driven, scale-driven, capital-driven, not easy to prove out with very little money. So if you go and choose something which is fundamentally very long-term and you know that you have to build profitable unit economics, I think it's as good a time to be an entrepreneur as ever.
So taking from what you said about some of the, the bigger companies that have set a benchmark now, Shekhar, how much harder does that make it for some of the younger startups? When they're feeling that pinch or feeling the pressure of raising multiple rounds and keeping up with the kind of benchmarks that have been set?
So, there is always money available in the country, but for right type of businesses. If the business economics are good, the sizable market, as well as the teams who know exactly what they're doing, then definitely there is money. Yes, there are large investments that have happened in our our own India, large 6 unicorns, what you would say. But there are many that are building up, and and India macro has not changed. We are very bullish. Another $2 trillion of business is going to be, the value going to be created in India, fastest growing economy, and extremely low-hanging fruit. For any entrepreneurs who promise something and deliver on what they promise, they'll create value. So nothing has changed per se from the underlying market from a consumption story perspective. It's the question of whether you're in the right area, right place, or you have a winning combination, and can you demonstrate the scale, success, and unit economics? And nothing has changed. Even at Accel, we have done almost 10 plus deals in the last 2 quarters. So nothing has changed in many of the firms. Yes, there are more entrepreneurs, more supply of good quality entrepreneurs. We're seeing the change. But from an overall perspective, keep your eyes on the business and make it happen.
Also, Abha, from a benchmark perspective, I want to make a point. It's one of my pet peeves. I think we focus relentlessly, media does, entrepreneurs do, on how much money has been raised and at what valuation. That's absolutely irrelevant. The benchmark for each company ought to be in whatever they are working on, how much, price optimization was I able to do? Was I able to sort of create something newer, cheaper, better? How much impact did I do? What was the service value that I drove? How many people's lives got changed out of this? How much time did I save? If you start looking at benchmark that way, then I think you will serve yourself better than trying to look at somebody else who might have raised more money or more valuation. That is not what we should consider a benchmark at all.
Right. There have been also a lot of questions raised with regards to the kind of relationship between a VC and an entrepreneur, given the kind of pressure that some of the companies have faced, given those multiple rounds of funding and so forth. Vani, what's the takeaway here? Because we've had some lessons that could be learned as well through some of these examples of the last year. What would you advise an entrepreneur to think about when they're actually going about building a relationship with a VC?
See, every entrepreneur thinks somehow getting VC funding today in India thinks that getting VC funding is the right step. It may not be the right step. Maybe the business is really a lifestyle business, and there is nothing wrong with that. Lifestyle is a good word. But a VC model works in a certain way. It works in a certain way as in venture capitalists expect extraordinary return. And of course there is extraordinary failure in terms of number of companies that don't get there. But in order to get to extraordinary return, you have to create a disruptive business. So everything is centered around that as the prime mover. And that's really where the friction happens, right? When a company is growing great, everybody is happy. When the company starts growing as much, then everyone is in the kitchen trying to figure out what has gone wrong. And that's really where, if there isn't a maturity from the entrepreneur and or the investor and having these very difficult conversations, then we see a lot of the things that we have seen, read, vicariously been entertained. But it is not entertaining at all to be part of that process. So I would tell entrepreneurs here and venture capitalists as well to be judicious in how much money you raise and when. And when you're raising, know that it comes with a certain expectations, right? So you can't be signing up for driving a Formula 1 car and wanting to drive slow. It can't happen. So, I think in raising money, there is a protocol of how fast you are believing your business can grow.
Right. Karthik, I'm going to bring you in here and also ask you whether or not there's also a battle within dealing with multiple investors as well, and how does one handle that? How easy or difficult is it? Even from an investor point of view, sometimes it must get a little difficult to handle.
I think so. One is the expectations of each set of investors, right? So angels typically, even if they get, because it's their personal money, if they get 4 or 5 times their money, it's fine.
Yeah.
But effectively, that would mean putting a company in a 50 to 100 crore valuation range, let's say, which is grossly insufficient for a venture capitalist to justify the time and the investment into that company. So what we see is at every round, the stakeholders change, the expectations change. And then effectively, if the founder is not clever enough to separate those expectations, and arguably some people say, oh, angels were made to exit very quickly, just because the orientation is not the same, right? Yeah. And most of the time, they're quite happy to take the money and step out. So that's one set. And then when you come to multiple venture capitalists, I think there are two sets of issues, right? One is even when the business is growing, at early stage, a lot of these things are very nebulous, right? Is this the right business model? Should we expand? Should we focus on unit economics? And there are going to be differences in the room. It's never going to be everyone thinks the same. And so the entrepreneur is constantly balancing out how to, maneuver it to what they eventually want to do, because it's their business, but also they're all stakeholders. And they realize that it's not their company alone anymore. They have all shareholders on the table, and all shareholders have to be on the same page. So I think that becomes a challenge. And then, of course, the biggest challenge is, I think, when you reach that point where growth is not at a scale where this cannot grow 5 times from here, which means the new investor is not coming in. And does that mean you sell the company? Do you get an exit? Do you sell it to a strategic? Do you get the investors, financial ones, out of the way? Those are never easy conversations. And if you don't have all the investors on the same page, again, it's a problematic area. So I think all of us are maturing. It's not a very large ecosystem. That's the good news. So we can all work with each other, set ground rules for how we'll make this happen. And I think we're becoming more and more mature on how to deal with these situations and work with each other.
Shekhar?
Yeah, so I think, entrepreneurs on an everyday basis have to make choices. And those choices, or right or wrong, will change the dynamics of all the stakeholders. And with the competition being fierce, how much of runway you have, and you want to be the leader or you want to be the follower, you want to focus on profitability or unit economics or growth, you want to own the regions that you care about versus, I want to spread across India and own every market, and potential entrants coming from global competition into India and saying that I will write unlimited checks. So, it's not an easy task, but analysis paralysis also kind of fails. Sometimes you have to make the choice, what is right for you and what is right for the company, and carry the board along with them. And there is, whatever you do, there's going to be some rub-off if company is not doing well, if these choices are hard choices.
Also, I think, entrepreneurs could and should invest into themselves in learning and ramping, because they have to be one step ahead from learning. Boards get very complicated. When you have an angel managed board, they're very involved, engaged, nurturing. You get the Series A investors, it's along the same spectrum. But then suddenly you're jumping into bringing hedge funds and so on and so forth, and they work differently. Not right or wrong, it's not a judgment. It's just that their expectations on the level of engagement and involvement will be different. Maturity they expect from the company is different, and oftentimes companies are not prepared for that. So there is enough history in India now for 10 years. So as an entrepreneur, you also need to be investing in being one step ahead and how you manage your board, how you prepare your company. You have raised 20, 30, 40 million dollars and you still can't get a board deck out on time or can't close your books. And this happens really, right? And and there is no reason to put into that situation. So there is a steep learning curve, but and you can make that easier if you invest into it proactively.
Okay, a quick round of closing comments then. Karthik, let me get you to add to that and also get a sense of, where you're going to see value and opportunity going ahead in 2016.
Sure. No, one lesson from all of these experiences historically has been that, when there are multiple investors on board, there's a saying in the Valley, right? All a VC has is his reputation or her reputation, in the case of Vani. But basically, over a period of time, the ecosystem judges you, right? And our business, there's no exit period in our business.
Right.
We're stuck to this for life, right? And so if you don't, build that reputation that you are a sensible investor, entrepreneurs today have gotten very smart. They reference check us, right? Not just down to firms, even down to individual levels.
Right.
So over a period of time, they will know who they want to work with in some sense. And again, there's no good or bad. Some people like the aggression of a person A, some people like the understanding and emotional quotient of a person B. And so I think it's an evolving ecosystem, it'll get there. So that was my summary on that point. Where we think it'll go, in one sense, I feel like our job is a little tougher as you keep going down early. All of us are early stage investors. We're supposed to spot trends and bet into something which is arguably 3 years out. If you're already betting on something which, Tigers put $20 million into, then it's a capital game. It's, it's very difficult to compete on differentiation, right? So when you're looking at new business models, et cetera, we have to see what's coming down. In our view, for example, it is the fact that we're finally moving away from the 40, 50 million urban users to the next 250, 300 million, semi-urban, not necessarily rural, but next income brackets. And suddenly everyone is armed with a smartphone. And their needs are very different. So I think media, entertainment, health, education, financial. So basic, Maslow's hierarchy going slowly upward, those are going to be big drivers from our perspective.
Shekhar, you touched upon this earlier, and I just want to, come back to this as we close. Do you see 2016 as a year for big bang deals or one for further rationalization, maybe more number of deals but more rationalization? Because as Karthik also just said, we have had certain, big foreign investors come in and skew the market a little bit, So do you see that shift going ahead?
I think the leaders and the winners in the market will continue to raise money because there is enough appetite for this market. Market has not disappeared. Of course, competition is there. So on one, it's like a dumbbell shape. On one side, you have leaders, they'll continue to do well. On the other side, you have lots and lots of seed and early stage activities of new age thinking. Also, at our firm, we love to look at global plays out of India as well, and enterprise plays. That's also gaining a lot of traction. A lot more enterprise companies are coming in the way where they can make more money much faster into a profitable situation than what it takes in the consumer place. So any efficient models were not capitally heavy and asset light and disruptive, has got room to play in 2016.
Vani, the next big thing to watch out for, 2016.
The India macro, like Shekhar was saying, I think that's solid. I think we all believe that. And at Kalaari, the number of investments we have made traditionally will continue to make. We are not slowing down. But the kind of founders who have deep clarity on their unit economics show the DNA to be capital efficient and understand that capital raise is not an easy path, not an impossible path. Like Shekhar said, money is available, but they understand that there is a process to it and you have to get to critical milestones and manage the money that you have very cogently. Right. So we are looking for those kind of founders today. Maybe that was different 2 years back. And the kind of business models then have to be things that maybe are premature today because we don't know what exactly is going to work, and that's our job to be able to willing to look at the future along with you for 3 years, 5 years and invest into it. But models that can really be creating large impact businesses, be that be enterprise or consumer. Of course, in a consumer, the challenge continues to be that most consumer plays require significant asset investment. So we do those deals, but we balance that with companies that maybe don't need quite hundreds of millions of dollars to be viable and profitable.
All right. On that note, thank you so much for joining us
today
for that fantastic conversation.
Yeah, thank you.